Good morning. Good morning. Thank you for joining us today. Welcome to our Table Talk. And today's subject will be talking about the market today, the current market. And joining us today, we have the infamous James Adamson from Ameris Bank. He is the Vice President, Senior Mortgage Banker, and he's a member of the President's Club from 2014 to 2022. So I'm going to turn it over to Mr. Adamson, and we have a lot of interesting topics that we want to discuss and information of how, because of the high interest rates, I call them high, based on what we've experienced for the past few years, 2%. Now we're up to what, 7, close to 7? So perhaps you can give us some encouragement and some ideas on how a first-time home buyer or even a move-up buyer can maneuver in this market today. Mr. Adamson?
Thank you, Sheila, and giving me this time to go over the market and what's going on. Again, my name is James Adamson. I've been a mortgage banker for around 35 years. I've seen it all. And what I'd like to do today is just kind of give an update on what's going on in the market, why we are where we are, and what we can hopefully look forward to in the near future. As it stands right now, the reason for the increase in mortgage rates really comes to one thing, and that's inflation. Everybody's heard that on the news over and over and over again. When a market is doing well, like ours was and still is, and that market just continues to grow and grow and grow, sometimes it can grow too fast and too big to where it creates inflation, and inflation starts to go up. So the important thing to remember is that inflation as of end of June was at its highest level since the early 1980s. Now, 1980s, if you go and talk to your grandparents or anyone that had a mortgage back then, those interest rates were 12 to 15%. So, we're, as a society, the younger generation is kind of used to that 2%, 3% interest rate because that's all they've known. They've grown up with it. And to be honest, those rates were, the best way to put it, were not real. Since 2008, when the market tanked, the Feds were buying billions of dollars of mortgage-backed securities. They were doing that to keep the market moving forward and hoping to grow the market. And a lot of us think they probably did it for too long. And that's why the market took off so fast. But by them buying those mortgage-backed securities, they were artificially making those interest rates lower. So for those of you that are sitting around saying, well, I'm going to wait till the rates drop to 2%, 3% again, that's probably not going to happen. That was a one-off. That was the Feds buying mortgage-backed securities, artificially keeping the rates low. The bond market was doing well, which helped keep the interest rates low also, and the economy was chugging along. So, before that time period, the lowest rate I had seen would probably be in the 3 range, high percent 3s. Now, the problem right now is they've got to get the inflation back down to 2% is their goal. So the only way to get inflation down is to slow down the economy. And the only way to slow down the economy is to raise interest rates. So when you hear the Fed say, we're raising interest rates, a lot of people will freak out and say, oh, the mortgage rates are going up. But that's not tied to mortgage rates. What that's tied to is the prime rate. So when you go to get a home equity line, when you go to get a second mortgage, car loan, credit cards, that prime rate is the rate that got raised, and that prime rate will affect those rates. So anyone that's bought a car 2 years ago probably had a 2-something% interest rate. Anyone that's buying a car now could be anywhere from 5 to 7%, depending on the credit. So, there's been a significant increase in rates. Now, the Feds did not raise rates the last go around because the inflation seemed to be slowing down and maybe even dropping a tiny bit. But the Feds have said they're going to raise it at least 2 more times before the end of the year. That's their estimate right now. So, those are the things that help drive interest rates up. But the key indicator on whether mortgage rates go up or down is the bond market. And the bond market, it's been going sideways as investors wait to see how quickly inflation is subsiding. So when looking to see what's going on with interest rates, the bond market is going to be your best way to monitor that. Now, just last week, actually this week, beginning of this week, the rates got worse again. So it's a little bit of up, a little bit of down. No one knows for sure how long this is going to go on. If anyone could figure that out, they'd be living on their own island. But the best guess from what we can see that's going on in the market, this is probably going to carry on throughout this year and into next year. Average interest rates since I've been doing it have probably been in the 6% range. That's why it's funny for me, not really funny, but I've seen, I remember the refi boom at the beginning of the 90s, where we had 9 and 8% interest rates and everybody was falling over themselves to refinance their mortgages. And that was because they were at 12 and 15% interest rates. So again, it was such a long period of time that the Feds were buying these mortgage-backed securities, which is why a lot of us think this is their fault. It might be, one of the reasons why, there wasn't a steady decrease of buying mortgage-backed securities. If you remember, I think it was the beginning of end of last year, around December, the Fed stopped buying mortgage-backed securities altogether. And right after that, bam, rates started shooting up. So, those 2 or 3%, low 3% interest rates, I don't see them coming back. So if you're a borrower and you're saying, I'm going to wait till the rates get better, that ain't going to happen. I do not see that coming back. What I do see coming back is possibly high mid 4s, low 5s. That's what we're hoping for by, sometime next year. Again, no one knows for sure. I mean, something crazy could happen. We could end up seeing inflation take a nosedive, which would be a great thing, and the rates come back. And, again, if anyone knew how to predict that, we would be living on our own island. But unfortunately, we can't. So we just got to wait and see what happens with the market. So right now, that's the Fed's goal. The funny thing is as they try to slow down the market, it won't slow down. It continues to, add new jobs. I think at this point it was, there is 1.7 open positions for every available worker. So there's still, jobs out there. The market, companies are still hiring. And the inflation is coming down a little bit. So I think that's why you're going to see the Feds most definitely probably the next meeting drop the rates or increase the rates by 0.25% again, just to try to temper that a little bit more. The other thing to keep in consideration is with the strong market and the inflation coming down some, and if that trend continues, hopefully you'll see the rates start to come down a little bit beginning of next year. So I hear some people saying, well, 2008, we could be looking at 2008 again because the prices of the houses are going up, which is rare. Rarely do you see rates go up and the price of houses go up. One of the reasons for that is the lack of inventory in the housing market. So, and one of the other things I hear people talking about is well, this could be a 2008 all over again. I don't see it being another 2008. In 2008, we would sit down with the client, ask them what their income is. They would tell us, and then we just write it down on a piece of paper. We wouldn't verify it. We wouldn't check it. And it got completely out of control. I had nurses buying $1 million houses with helicopter pads on their property, trying to warn them, don't do this. And there was no checks and balances. Since 2008, everyone that owns a house now, the majority of them had to qualify for that house. So a lot of them are, the concerns of mass foreclosures and such. I don't see that happening. And in fact, the number of foreclosures right now is very good compared to other markets. So we're not seeing people foreclose on their property. The problem is if you owned a house and you had a 3-bedroom and you just had your 4th child, you would normally go and buy a new house. But you sit and you look at your mortgage statement and you see a 2.75 interest rate. And then you see that the interest rates are 6 or 7%. And you scratch your head and you look at your wife and you say, do we really want to buy another house to get that extra bedroom and lose this interest rate? The sane answer in most cases is going to be no. Let's double up, Junior with his sister in this bedroom, or put him in the basement, and we will wait and see what happens. That's the reason the inventory is so low. People that would normally move up in family size are rethinking that because of the rate that they currently have, which goes back to the Feds buying those rates down so low and keeping them there for so long that everybody thinks that's the normal, the normal thing. I'll wait till they get to that. The problem is there's no education going on saying, look, you may never see that again. You need to look at history. Is a great thing because it lets us not make the mistakes we've made in the future, but it also lets you see what really is going on. So if you go back again to the 1980s, it was 12-15%. Nobody blinked an eye at that. That's what it was, and if you talk to your grandparents, they'd say, oh yeah, what 7%? That's a great rate. But now everybody's so used to that lower rate, and the problem is it's educating everyone to understand that wasn't normal. That was the Feds. Now, one of the other reasons it's almost shell shock because it happened so fast. When the Feds immediately stopped buying mortgage-backed securities, I think it was around December of last year. I mean, you just saw the rates shoot up. And then you had Fannie Mae and Freddie Mac come in and say, you know what, we're going to make some changes ourselves. We don't like how people are using this second home option. So we're now going to make it comparable to an investment property. So now all of a sudden, where people might be wanting to buy a second home in Ocean City or someplace like that, it was like buying an investment property. They couldn't do the 10% down anymore. They had to put the 20-25 to get a decent rate. The Fannie and Freddie also raised some of their adjustments on credit scores and stuff like that, which caused a shift in rates to cover that Fannie Mae and Freddie Mac adjustment. For a big part of this year, a lot of people don't know that most mortgage companies that closed a loan were losing $2,000 per loan. We really couldn't make any money on it because there's no one to really sell it to and make a profit. In fact, some of the mortgage companies have gone out of business. There was one in particular where they just called their employees and say, just pack your stuff up and leave. They had loans at closing table they couldn't fund. People were sitting there waiting for their funds. So there's that kind of shifting going on. The market is making a shift, and the ones that the banks and the mortgage companies that prepared for it will be okay. The ones that got aggressive are going to feel the snap. Hence the two banks going under. Concerns about possible other banks. It's as fluid, it's constantly changing, and it's impossible for the everyday person to know exactly what's going on, because the information, one of the hard things for us is the internet, which has a lot of misinformation, and your news outlets. We find that your news outlets are 3 days behind what's actually going on. I'll get calls from borrowers saying, I just heard rates are going up. I said, yeah, that happened 3 days ago. Wow. It's just, it's very important in this market for a borrower to have an experienced realtor and an experienced loan officer that's watching out for these kind of things and can let them know what's coming down the road. Because it's too much for any borrower to understand what's going on. Now that I've scared everyone that's watching this thing, and like, well, why should I buy a house then? Because it's still a good time to buy. You see 6, 7, you're freaking out and thinking that, oh my God, that's a crazy rate. It's really, if you look at the average rates, they're around 6%. If you were to average out the rates from their time, when they first came out, it's going to be around 6% something. The other thing to remember is that you're lucky because you live in our market area. The DC metro area is probably one of the strongest markets in the nation. People would say, well, what about California and New York? And those places, when 2008 happened, it was like a speed bump for our market area. We felt it for a little bit and it was gone. While other places like Miami and Michigan and New York and California, it just, they took years to get through that for them. One of the benefits for us is that we, as bad as it, as bad as the market is right now and the housing inventory is, we should be doing much worse. It should be worse right now to the point where it's almost impossible to get a house. But the benefit for our market is we have the Congress, the Senate, the House, and every 2 years there's turnover. And when these people come into our market area, they bring their assistant, they bring their, spokesperson, and a lot of these people end up moving in this area. And some of them stay and some of them go. So there's constant movement and houses coming on the market because of that. Where our market is, it's a strong market. There's always, a high demand for houses. So even though the housing prices are higher, I don't think you're taking a chance by paying that higher price and worrying that you're going to lose it a year or 2 or 3 from now, like what happened in 2008. The reason is, again, people have to qualify for the house, and B, there's constant turnover. There's constant churn. We got Baltimore. We're not far from New York. We got Baltimore. We got DC, and we got Richmond, which is one of the hottest hubs in the nation. So it's still a good time to buy because of that. Yes, you're going to qualify for less because the interest rates are higher, but there's still down payment assistance money out there. The government knows what's going on. They see it. HUD sees it. So they try to come out with new products and stuff to help these home buyers, because honestly, the people that are buying houses right now, there's still people that are moving up because they can get a good price for the sale of their house and use it to purchase a bigger house. But also, there's a lot of first-time home buyers buying right now. A lot of people that don't have cash to close, but there's programs out there to help them get it. And the important thing to remember is when you get this rate and you close, you're not stuck with that rate for 30 years.
Right.
So if those rates come down a year from now or 2 years from now, half a year from now, you can refinance out of it. You're not stuck at that rate. But it's one thing we do is we keep a database of all our clients that we've done loans for and what their interest rates are. If we see the rates dip, we shoot an email out immediately to them saying, hey, now's the time to refinance. So it's not a snapshot, and that's the way it's going to be for 30 years of your mortgage. You can always refinance out of these rates later on. If they get worse, you still have this rate. You don't have to worry about it going up. And a lot of these down payment assistance programs now are free. I mean, they're forgiven after 5 years. We've got the Ameris grant that gives up to 12.5, and that is forgiven after 5 years. It goes down 20%. So it's a good time to look for a house, because as discouraged as you might be as a first-time home buyer, there's 10 other people that are just discouraged enough that they're not even going to try. So you might as well get out there and see test the waters, see what the market's like, especially for the first-time home buyers, because even with the higher interest rates, your rent is probably still going to be higher than what your mortgage payment would be.
Wow.
And investors are not stupid. They know that. And they look for any and every opportunity a landlord does to raise your payment. And if they see that the mortgage rates have gone up, then they know they can raise their rent payment too for those individuals that can't buy right now. So, and you see it all over the place. You see houses that you would have never imagined that would be rented for $4,500 a month, and people are paying it because they don't have any other options.
Wow.
So, it's eventually going to straighten itself out. Like the family, my hypothetical family that just had another kid. Well, a year from now, they have their fifth. Okay, well, now we got to move. We have no options. Wow. So, eventually it'll catch up. More people will be putting their homes on the market. I think you'll see an increase on it. And a lot of it is, going to be a combination of, like, builders have been sitting on land. They haven't been building. And they have plenty of land to build on. They just are taking their time and only putting so many houses out in the market.
Right.
So, it's a combination of that. It's a combination of new home buyers, a big combination of people moving up in house size. And I think once people get used to the fact that this is where we're at, this is where the rates are, it's not going to change anytime soon. This rate, it's not what I wanted, but I can refinance out of it in the future. I think everybody's just shell shocked right now, and they're still trying to get through it, and they're still trying to understand it, and they're still trying to, ask themselves if this is a good time to buy. And what I would tell any homeowner that's looking to purchase, I would say, look, you need to get with a professional, have them pull your credit, even if you plan on buying a year from now. Have them pull your credit, tell you what you need to do to fix it in that year's time, so that when you are ready to buy, you're all straight, you've gotten your credit straightened out, you've saved a little bit of money, and you're ready to purchase. But go to the experts. Don't, I would never go to my brother and ask him for mortgage advice, because he doesn't do it. Be leery of, if you talk to family or friends and Again, everybody's an expert in this business. Don't just go off of that. At least talk to someone that's in the business. I'm a firm believer in, I'm going to tell you the truth, not what you want to hear. I will put it out there for you, and then you can make your decision. But, unfortunately, the people that you might be going to already got that 2.5% interest rate. And, they haven't been doing it 35 years. They haven't seen the market turn and stuff. And this one is probably the most strangest of markets that I've been through. I've never seen rates go up the way they have, and the market just laughing and keeps going strong and strong and strong. Most of the experts say that for as bad as it is, the mortgage market is very resilient right now. It should be a lot worse than it is. But I think there are people out there that know I need to get in now. I don't see these prices coming back down. It just is what it is. But again, you can always refinance out of these higher interest rates and into a lower one.
So Jay, a quick question for you. So, is there a benefit, if you will, for someone who buys a home now at the current interest rates from a tax perspective?
Yes, that's a very good point. And that's the other reason that I think that's a good point. And I think that's one of the reasons that first-time home buyers are still out here shopping. They're paying these crazy rents. They're like, why am I paying this much money for rent? I hear my neighbors screaming next door. People are acting crazy out in the park next to my house, or just things like that come with renting. That's just something that comes with renting. And they're like, the tax benefits of owning a house far outweigh the interest rate. Even if your mortgage payment was higher than your rent, you can still write off all the interest, all the property taxes every year. So most people that don't own a house are claiming zero exemptions, because if they did claim an exemption, they don't taxes at the end of the year. If you own a house, you could probably claim 2 to 3 exemptions on your tax returns, at least 2, and still not owe at the end of the year, but get more of your paycheck back each pay period to cover that mortgage payment, to help cover it. So when you look at it in that sense, it's not as bad as you would think compared to renting. And you're building equity. I mean, when you interview most people, their biggest source of equity and retirement is their home. Your 401k is going to follow what the market does. I mean, a lot of us, I know I'm one of them, stopped opening my 401k statement when I got it because I knew it was just going to be ugly. So I didn't even want to see it. So I just left it in its envelope. But, the house is there. It's in front of you. You walk up to it every day. You sleep in it every day. You leave. It's a tangible thing that you can see. Where your 401ks and your stuff like that are with some Wall Street guy, and you're hoping he's not going to do a Wolf of Wall Street, or the market's going to turn, and you're going to be caught in the middle of it. Because let's be honest, when the market turns, there's not a lot you can do at that point except ride the wave. But yes, that's a very good point. I think that the buying a house is one of the best investments that you can make for yourself and your family. And it's, I see people all the time, especially in the DC market, where mom's owned that house forever and she sells it to her, grandchildren, her son. She moves into a retirement home. It's something that can be handed down, from generation to generation. But yeah, I think it's still busy. People are still out there looking to buy houses. It's definitely a tougher market. You need to be with people that got your back. And, you have to be resilient and just keep going at it. I've had clients that have been at it for a year and finally find a house and get it done. But yeah, it's a tough market out there, but I still think it's well worth purchasing a house, knowing again that you can always refinance down the road.
Fantastic. So so my perspective on this too, is that I see where there's more, if you will, benefits of buying a home, in this market, just based on a lot of things that you stated. I mean, the tax benefit there. Also, you're building equity into the home. And on average, how long would you say it would take to build equity into that property when you first buy that home? How long does that normally take to build equity?
I would say to get a decent amount of equity is probably 5 years. But in this market, it's a year. It's
Wow, isn't that
2
crazy?
years. I've got people that bought a house 2 years ago. They got 50 grand of equity in their house. That's what makes our market so unique. I do loans all over the place. I do loans in Florida. I've done loans in Michigan, Indiana, California, and I can tell you, like, the markets are completely different in other parts of the United States compared to this market. It's very resilient. Again, it's got a lot of activity. Your nation's capital's right there. Amazon wants to be here. FBI, building a new office. There's jobs. There's plenty of jobs. I mean, it's just, it's a strong market, and there's always people looking to purchase. So, and again, if you're a first-time home buyer, you may have to come down on your expectations. But you can still get a nice house or a nice condo or something nice compared to, what you would get rented.
Yeah.
I mean, the mortgage payments and all that still are right in there with what rent payments are. And the problem with the rent payment is, you're building the landlord's equity, not your own. It's just wasted money. Yeah. Can't write it off on your taxes, nothing. It's just money that goes out the door.
So, it's really interesting too, because I think that, first of all, I appreciate you clarifying what happens with the rates and who controls those, because I think a lot of times consumers or home buyers think it's you, the lender.
Right.
So you just want to arbitrarily just change rates and just increase rates and, but it doesn't work that way. So I think that clarity really is fantastic. That information is fantastic information to really help consumers understand who's really controlling the rates and what it is that you as a lender have control over and what you kind of, really don't have control over. But the good thing that you do have control over is programs that you can offer where there may not be, if state programs run out, there may be programs that you as a lender can offer, such as, the different types of down payment assistance programs that I know that that your bank offers, and the grant and programs of that nature.
Mm-hmm.
But I also think that one of the key things that you stated too was that you really need to get with a professional, get with a realtor, a professional realtor, and a lender. And we appreciate the feedback from friends and family, but like you said, their situation was what it was when they bought a house.
Right.
What's happening right now looks something that's totally different. And so in times are different, and what's happening in the market is way different, even just 5 years ago, even last year, like at this time last year. So getting with a professional is really important. I think that a lot of first-time home buyers are scared to take that initial leap because they hear of high interest rates. Because if you never bought a house before, how do you know what that experience is and what that rate should look like?
Yeah, it's tough because as far as the interest rates go, you're absolutely right. I mean, I come across borrowers like, well, I want this rate. I said, well, if it's up to me, I'd give you 1%, but I don't set the rates, the feds do. The market does. Can rates vary from one mortgage company to another? Sure. But in 2008, I mean, they put a cap on what loan officers can make anyway. So, you will find some mortgage companies that aren't banks that their loan officers get paid a higher percentage than I might. So they make that up in higher interest rates. But, most bank employees like myself, we're set on what we can make. The feds come in, audit us constantly because we're a bank. So we can only make so much. And it's not like, I'm giving this person a higher interest rate so I can make more money than that person. It's just whatever the rate is that day is what you're going to get. And it's, and to your other point, every deal is different. You could do 5 different FHA loans and every one of those FHA loans is going to be different from the other. It's not vanilla. It's not, okay, well, I'm doing an FHA. It must be, it's probably going to be identical to what my mom went through. No, it's not. There's going to be stuff that's different. Things we'll have to work through, things we'll have to work around. So every deal's different. I hear all the time, well, my mom didn't have to do this. Well, your mom didn't have a BK, so this is what we're going to do. So it's just constant education and letting them know, this is why it's different. Because a lot of times it's not, a lot of people think we have the control, we can do whatever we want. When we ask for something, it's because Fannie Mae wants it, Freddie Mac wants it, VA wants it, or FHA. That's the only reason we're asking for it. We're not asking for stuff because we want it. We're asking for stuff because those guys are going to want us to get it. So, it can be, it's a challenging process. But again, like you said, if you're with the right people, it's not as bad. I get clients call me all the time. I just had one 2 days ago, so frustrated. And we just talked through it and he was like, all right, I get it now. I understand. But it's, you're not, I always tell my clients, you're not buying a toaster oven, you're buying a house. So they're going to ask for some documents. So let's just get them what they want and we'll get you into the house.
Yeah, I think sometimes people struggle with providing the information because they feel like they're really kind of getting into their
Right.
business and into their life, and and you're not. You're exactly right. Sometimes that's where the relationship with the lender and the realtor becomes key too, so that can help explain that and help kind of help massage that a little bit better, so that folks understand that this is you're asking for somebody else's money. You're asking for money from someone else so that you can buy this house.
Yep.
So they want to know that you can pay them back. Sure. So, we need to make sure that, that information is provided, and that, and then honestly, just being upfront about what your situation is, because a lot of times I'm sure that you see this too. They may not, the customer or the buyer may not reveal everything, but you'll find it out there. So yes, be upfront, and that way you can work with them to figure out what the plan of action would be at that point, because you don't want to get to a place where you've submitted an offer, and you're thinking you're moving forward, and come to find out, hey, you didn't tell them that your child support. Okay, well, we found that.
I don't have enough fingers to count how many times that's happened. But yeah, it's very true. I mean, I always joke around that I'm loan officer / counselor, because I'm constantly helping people. What's amazing to me is the amount of people I talk to that think they can't qualify for a house, and they do.
Yeah.
I mean, if you're a borrower out there and you think, I can't, I'm not going to qualify, you're not going to know until you speak to a loan officer. Because the important thing to remember is everybody now monitors their credit on Credit Karma and, through their credit card companies or directly with the agencies. None of those scores are what I'm going to see. Mortgage credit report is going to be, our score is going to be normally 30 to 10 points less than what they see on Credit Karma. And a lot of people don't know that. So that's why it's so important to get an actual mortgage credit report pulled so you know exactly. And I'll get people that, while I'm working on it, I said, has anyone looked at your credit? No, I'm like, you really need me to look at it to help you. Like an example is, a big one is they might have a collection account that's 5 years old. And they're like, well, I'm going to pay this off. And they think they're doing a good thing. But once you pay that 5-year-old collection account off, your scores are going to drop. And the reason they're going to drop is because that account's been inactive for 5 years. And now you've paid it off and boom, it's back in front of the computer system and it sees that it's been, it now has a last activity of, 5 days ago. So, things like that people think they're doing a good thing can come back and bite them. Medical collections don't have to be paid. So that's why it's so important to get with the loan officer, because our systems have become so advanced that when I pull credit, I can ask my credit system to tell me exactly what I have to do to get to this score or that score. So it's so detailed, it'll say pay down the city card to 159 balance.
Oh, wow.
And this will get you to this score. So, they'll never get that off of Credit Karma. They'll never get that off of any of these agencies. Only a mortgage lender's got access to that kind of stuff. So,
Do you use the 3 major credit bureaus?
Yes, I always pull all 3 because we have to take the average of the 3. So that's a good question, because I've had borrowers come in and say, well, my Equifax says this. And I'm like, well, there's also a thing called TransUnion Experian. If both those say 500, then it doesn't matter what that score is. We have to take the average. So, and the only way to get that average up is to look at all 3. We might have to rescore 2 of the bureaus to get us where we need to be. And at that point, it's up to the borrower to do what they need to do. But again, I've had borrowers come back a year later saying, I think I've got it, everything you wanted me to do. I've boosted scores by just adding a customer to a husband's credit card as an authorized user. I just had a borrower that was at 650. I got him to 700 by just adding him to her husband's credit card as authorized user, because it gets reported. And he had a low balance, been open for a long time, made payments on time. So that boosted up the score. But those are the kind of things that we can, whoever's trying to give them advice won't know. You got to go to a lender to help get them to help you with that.
So would you suggest? Oh, go ahead, Linda.
Okay. So let me ask you a question. And I'm sorry I came on a little late, but you just mentioned about when you have collections on your credit. And let's say if it's not through a credit card, but it's through a company, let's say an apartment complex or something, and you were going through a discrepancy with them and they put that on your credit report. When you get that paid off, so that's not like a card, you have been an active payment. So when you pay that off, will that still, or after the 5 or 7 years, however long it takes for that to drop, will that still affect your credit score negatively, or since that's gone?
Yeah, it depends on the length of time.
Okay.
So let's say, like, not all collections have to be paid. It's any medical don't.
Okay.
FHA, I think, is $2,000. If it goes above that amount, then you have to pay. So what I would do in a situation like that is, if it is say it's 5 years old, and I know if they pay this, it's going to mess up their credit, I will say, look, you're going to have to pay this anyway. let's pay it at closing. We can keep your credit score the way it is now, and then we'll pay that collection at closing. And then all you got to do is just get a letter from the collection agency agreeing to an amount. We'll pay it at closing. We don't have to rescore your credit, which is going to make it worse. We don't have to update your credit to show it's paid because it's going to make it worse. And we'll just go with the score that we have.
Okay,
So it's little
perfect.
things like that. Like, again, I've been doing it 35 years. So I know, and I used to be an underwriter. So I
Okay,
know, that, we're not doing anything wrong.
right,
We're just
right.
doing it the smart way.
Okay,
So, it's little things like that's what makes our job so, a good, it's good. It's hard to find a good loan officer out there because,
mhm,
we, especially in this market, we have to foresee everything. We have to be like a gypsy or something and try to look at all the documentation and try to find anything and everything that might pop up and, cause the deal not to go through. So, stuff like that is why we pull the credit. When we do a pre-qualification, we get all the borrower's documentation to the point where sometimes I can hear a little frustration maybe because
mhm,
they think it's Rocket Mortgage and they're going to give 2 sheets of paper and the loan's going to close, which it
mhm.
doesn't because they didn't do their homework.
Right,
So, we're going to ask for everything. If we see there might be a pothole, we're going to grab them by the back of their shirt and say, don't go that way, go this way
mhm,
and fix this. So, that's the hard part. And a lot of times, when we do the pre-qualifications, I consider myself kind of like a financial advisor. So when I get them pre-qualified and we make it work, I'm going to say, look, stop closing your revolving cards in the future because this is killing your score. Stop doing this. It's not going to benefit me any for the loan right now, but I try to educate them on what to do, what not to do down the road so they don't put themselves in this situation again. So, that's part of our job of being a loan officer is trying to educate them on everything, even things that, won't affect the mortgage at this time, but, caused issues. It's like, don't revolving cards are a big one. People love to close them, and then they don't understand that if you don't have enough revolving credit cards on your credit, then it's going to just, drop your score significantly. So.
okay.
So with all of that being said, we have to wrap up in a moment or two, but I did want to ask you a question. Is it okay, or would you recommend that a client go to one of the credit repair bureaus? Does that hurt their credit if that shows up on their credit report, or just come
I
directly
have,
to the lender?
yeah, that's a good question. I have mixed feelings about that. A lot of those agencies will spread that thing for years if they can because they get you to pay a $50 a month fee. So there's no benefit for them to fix it right away,
Okay.
or whatever the fee is that they charge. I would never go to a credit repair agency until I've at least talked to a loan officer first.
Okay.
And that loan officer says, nothing I can do for you at this time. Like sometimes this rescore won't work, but I can take a look at it and say, all right, well, this is where you messed up. This is what you need to do. You need to open up 3 credit cards, wait 6 months. I said, they're going to have to be secured cards because no one's going to give you a credit card with the credit the way it is now, and try to get them on a path to get there. I might tell them, you know what, contact the credit bureaus, dispute every negative thing on there. If that credit report or if that credit agency does not get back to them within a certain period of time, then the bureaus have to remove it. So you might drop 1 or 2 accounts off that way. But I mean, that would, to me, that would be a last resort kind of thing. Because all they really do is a lot of times is they try to get them removed or they dispute everything. And once it's disputed, it doesn't count as a negative account against the credit score. But Fannie, Freddie, FHA, VA has already figured that out. They know what they're doing. So if they have a certain amount of disputes, we have to make them remove the disputes so that Fannie, Freddie, and the rest of them can see what the real score is. So, my suggestion is go to a loan officer first and see what, if they can give you the advice that you need to fix the credit.
Right.
So, yeah.
That's good. That's a good answer. And thank you. I so appreciate you taking time out of your schedule this morning. Such a
No
beautiful
worries.
day out. No rain. So thank you so much for getting up early and sharing with us. I certainly learned a lot and I'm encouraged, and I will emphasize to my clients that even though the rates are higher, they will get a better tax break,
Yeah.
tax write-off, more of a tax write-off because the rates are high. So it has a silver lining, and I see that as the silver lining. And I so appreciate you once again, Mr. James Adamson from Ameris Bank. You have 35 years experience under your belt, and I'm certainly going to be calling upon you to share some of your knowledge and to help my clients that are in the market to purchase.
And I've got the grade to prove it.
It just means you're super smart.
Yes.
Or super stressed.
Thank you so much, James. We so
Yes,
appreciate
thank you.
You're
Thank
welcome.
you.
You ladies have a nice weekend.
You